Have you ever wondered how someone with no traditional Wall Street background built one of the most successful investment firms in financial history? Not by making bold predictions or appearing on television, but by trusting mathematics, data, and disciplined systems. While many legendary investors became known for reading balance sheets, meeting company executives, or making concentrated bets, Jim Simons approached markets from an entirely different direction. He believed that financial markets were complex systems filled with patterns that were difficult for humans to notice consistently, but could sometimes be detected through careful statistical analysis. His story is not really about discovering a secret investment formula. It is about replacing intuition with evidence, replacing opinions with testing, and replacing emotional reactions with repeatable processes. Although most investors will never build a quantitative hedge fund, many of the principles behind his success can still improve the way we think about investing, risk, and decision-making. The first lesson is that data should come before opinions. Most people begin with a belief and then search for information that confirms it. Simons reversed that process. Rather than asking whether a company seemed promising or whether the economy looked strong, his teams gathered enormous amounts of historical market data and searched for statistically meaningful relationships. If the evidence did not support an idea, they discarded it regardless of how convincing the story sounded. This approach reflects a broader scientific mindset in which hypotheses must survive testing before they deserve confidence. For individual investors, this does not necessarily mean writing algorithms or analyzing millions of data points. It means recognizing the value of evidence over intuition and being cautious about decisions based solely on headlines, predictions, or personal conviction. The second lesson is that small advantages can become extraordinary over time. Popular investing culture often celebrates dramatic predictions and once-in-a-lifetime discoveries, but Jim Simons built his reputation on identifying many relatively small statistical edges that could be applied repeatedly. Each individual opportunity might have appeared insignificant on its own, yet thousands of disciplined decisions accumulated into remarkable long-term results. This reflects an important mathematical principle. Compounding does not require spectacular gains. It requires consistency. Even modest improvements in decision quality, when repeated over many years, can have a far greater impact than occasional moments of brilliance followed by costly mistakes. The third lesson is that probabilities matter more than certainty. Human beings naturally seek certainty because uncertainty feels uncomfortable. Markets, however, rarely provide certainty. Simons understood that successful investing is often about making decisions that have favorable odds rather than guaranteed outcomes. Even an excellent strategy can experience periods of loss, while a poor strategy may occasionally produce impressive short-term results. Evaluating decisions through the lens of probability encourages patience and reduces the temptation to judge every investment based only on its most recent outcome. It also reminds us that good investing is about managing uncertainty rather than eliminating it. The fourth lesson is to remove emotion wherever possible. Fear and excitement have influenced financial markets for centuries. Investors often buy when prices have already risen substantially because optimism feels persuasive, and they sell after declines because fear becomes overwhelming. Simons attempted to reduce these emotional influences by relying on predefined systems instead of moment-to-moment judgment. His approach recognized a simple psychological reality. Emotions are valuable in many areas of life, but they can become expensive when they consistently interfere with disciplined investment decisions. Creating clear rules, maintaining diversification, and avoiding impulsive reactions are practical ways individuals can apply this lesson without sophisticated technology. The fifth lesson is that risk management deserves as much attention as return potential. Many discussions about investing focus almost entirely on gains, yet preserving capital is equally important. Every investment strategy experiences periods of uncertainty, and no statistical model works perfectly forever. Simons understood that controlling risk was not separate from achieving long-term success, but was essential to it. Investors who survive difficult periods retain the opportunity to benefit from future opportunities, while those who take excessive risks may permanently reduce their ability to recover. Managing position sizes, maintaining realistic expectations, and recognizing uncertainty all contribute to resilience. The sixth lesson is to respect changing markets. Financial markets evolve as technology changes, regulations shift, and participants adapt to new information. A strategy that worked consistently in one decade may become less effective in another. This is one reason why Simons and his research teams continuously tested and updated their models, instead of assuming yesterday's relationships would remain permanent. The broader lesson extends beyond quantitative investing. Flexibility often outperforms rigid certainty because successful decision-makers remain willing to revise their beliefs when new evidence appears. The seventh lesson is that collaboration can outperform individual brilliance. Jim Simons assembled teams that included mathematicians, physicists, statisticians, computer scientists, and researchers from diverse disciplines. Rather than relying on one exceptional investor making every decision, he built an environment where different perspectives strengthen the research process. This reflects an important principle in complex problem solving. Diverse expertise often reveals insights that a single viewpoint might overlook. Even individual investors can benefit from seeking thoughtful disagreement, reading multiple perspectives, and challenging their own assumptions before making important financial decisions. The eighth lesson is to focus on process rather than outcomes alone. A sound investment process can still produce disappointing short-term results because randomness always plays a role in markets. Conversely, an impulsive decision may occasionally succeed simply by chance. Simons emphasized building reliable systems capable of making consistently rational decisions rather than celebrating isolated successes. This distinction is subtle but powerful because judging ourselves only by outcomes encourages overconfidence after lucky wins and discouragement after temporary setbacks. Evaluating the quality of our decision-making process provides a more stable foundation for long-term improvement. The ninth lesson is that curiosity is a competitive advantage. Before becoming an investor, Jim Simons established himself as a respected mathematician. His intellectual curiosity shaped the culture of continuous learning that became central to his firm's research. Instead of assuming markets were fully understood, his teams constantly searched for better explanations, tested new hypotheses, and questioned existing assumptions. Curiosity keeps investors adaptable because it encourages ongoing learning instead of complacency. Financial markets reward those who remain willing to improve their understanding rather than believing they have already discovered all the answers. The 10th and perhaps most enduring lesson is that investing is ultimately a long-term discipline rather than a series of dramatic predictions. Public attention often focuses on market forecasts, economic headlines, and short-term volatility because uncertainty attracts interest. Yet Jim Simons demonstrated that sustainable success can emerge from patiently applying disciplined principles over extended periods. While very few people possess the resources required to build sophisticated quantitative models, everyone can benefit from approaching financial decisions with greater patience, evidence, humility, and consistency. Those qualities may not generate exciting headlines, but history repeatedly shows they are among the strongest foundations for thoughtful investing. Jim Simons changed Wall Street not simply because his strategies produced exceptional performance, but because he challenged long-held assumptions about how investment decisions should be made. His career demonstrated that careful research can outperform confident speculation, that disciplined systems can reduce the influence of emotion, and that long-term success often depends less on predicting the future than on building processes capable of adapting to it. Whether you invest through broad market funds, individual companies, or simply want to become a more thoughtful decision-maker, these lessons encourage a mindset grounded in evidence, patience, and continuous learning rather than certainty. Markets will always remain unpredictable, but our approach to uncertainty is something we can continuously improve, and that may be the most valuable lesson Jim Simons left behind.